So, hello everyone, welcome to the corporate finance course. Let me start. I hope my screen is visible to you. Is it visible?
Yeah, sir, it is visible.
Okay, thank you. So, I welcome you all to the corporate finance course. I am Sivratan Tiwari from the Department of Economic Sciences, IIT Kanpur. And so, l- let me first walk you through the course structure briefly. Like, this course will run for 12 weeks, and each week you will have like some video lectures, and you have to solve one weekly assignment which will have 20 questions in that. And for grading purposes, like, there will be two quizzes with an interval of 1 month, and at the end we will have final exam. And so if you have any questions regarding like the course structure or any other thing, you can ask me today, and like we can have a like Q&A session at the end of today's session. So agenda for our live sessions will be like, we will have a brief recap what we have learned throughout the week from the lectures, and we will solve some practice questions, like not in today's session, it is an introductory one. From next ones we will be solving some practice questions, and I will be taking on any doubts or questions. If you have, we will be having a Q&A session in each live session. Okay. So in week one, like, it was a introductory week, like it has set the stage for the entire course. So what we learned in week one, like, we started our discussion like how like the security financial assets market is different from normal goods market. So the fundamental difference is like, for the goods, like we buy them, purchase them for our consumption purpose, but in financial assets, like it is for our, like, there are other means, like we for speculation, for like gaining profit. Those are the reasons why we purchase them. So that's why it is a slightly different. And what are the type of assets, like we mainly discussed about two in the lectures, like stocks and bonds only. We will be touching a bit on that also, because we will be going through them again and again throughout the course. And another type of asset which we will be covering will be derivatives products, which we will cover at the end of our course. We had a brief discussion about like how risk and returns are related. We discussed about two types of risk, like one which is specific to a particular institution or the firm, which we call idiosyncratic risk, and another is like the risk which is like the prevailing in throughout the market, which we call the systematic risk. Correct. So the risk which is like specific to a firm, like we can diversify that, like we can, if we remove that firm from our portfolio, then we will not have that risk. So that's why we call that to be a diversifiable risk. But if a risk is like the prevailing in throughout the market, like to all the firms which are there, then we cannot diversify it if we are acting in the market. So that's why we call that type of risk to be undiversifiable. And we discussed like how risk and returns are related. So if you are investing money like in an investment opportunity, and you consider like it to be more risky, then you would want higher return from that investment. So that is like, so that fulfills our ideas of like high risk leads to high return. Correct. And later we also discussed about some trading strategies, mainly two trading strategies we discussed. One is the fundamental value. So in which what we do, like we assess, like we assess the value of a particular asset, like we do our analysis, our research, and we find, like try to find out like what is the fundamental value of this financial asset. Let's say for a bond, so we try do our research and find that the value of this bond is, let's suppose, 1,000 rupees. and in the market you go and find that this bond is selling for 900 rupees. So what you will do like this? So your valuation leads to 1,000 rupees, but in market you are getting it for 900. So what you will do, you will go and purchase it because you think that it is underpriced. So so if you find in this fundamental value trading strategy, if you find a asset to be underpriced, then you go and purchase it. And in the same way, if you find a particular asset to be overpriced, so it is priced more than its fundamental value, then you sell that asset because you think like in future it is going to a lower price. So this was the fundamental value, like the trading strategy based on fundamental value. A different type of trading strategy which we call the momentum trading strategy. What it says, like you see, like for an asset you see price to be rising, so what you say, like yes, it is following this trend, like price is rising, you follow the trend and you go with the momentum, and you think like it will keep on growing, and you purchase, and you like the gets profits from that strategy. There are many other strategies, and we will touch some of them later in our course also. So these are the two basic strategy which we discussed. If you have any doubts, you can ask them here, like regarding these trading strategies or any other basics of these financial markets. We can have a discussion on that. Also, we discuss like how like the financial markets works, like how trading is happening on the exchanges, like a buyer puts his bids and a seller puts his ask price, and if these two matches, then a trade happens. Correct, that was a discussion we had in one of the lectures. And later we move to like what is an bubble. So bubble asset market bubble is like when price of a asset is like deviating a lot from deviating a lot from its fundamental value, then we call like yes, there is a bubble, it is going into a bubble. Actually its price is not that high, but it is showing going to that higher levels. So which was happened in the financial crisis, the one of the major event in the financial market in the current century, which we call the global financial crisis of 2007 and 8. We had a quite a lot discussion like what happened during that crisis, how it is linked to the housing market of the United States, like how the financial intermediaries created these like the complicated structured finance products, and what role did rating agencies played in this financial crisis. So we discussed all of that throughout our lectures for the week one. And like these rating agency, there are mainly three credit rating agency. One is S&P and Moody and Fitch, and like there are various types of rating. So like the specifically for like the it starts from AAA, which is the highest rating, and goes to like the C grade or C rating. So there is a slight difference between these three rating agencies, but broadly more or less these are same. So what happened in 2007 and 8, like these financial intermediaries, which are banks, mainly the banks, they created very complicated products like by mixing different assets, and the like the rating these type of complicated products was very difficult, and it was very new to these rating agencies also. And they give false ratings to these products, and that lead to like very high prices for these assets. And what essentially went wrong, like they did not account for the correlation between these various assets. That was the main issue which was there during that crisis. So this was the major challenge for these rating agencies, and that led to like it started like when one product started defaulting, then it lead to a sequence because these are very correlated and which they missed out. So that was the discussion we had in our week one. So this was a quick recap of what we learned in our first week discussion. Now I would like to touch briefly on like the two things, like one is bonds and second is stocks, because we will be like the going again and again to these two types of financial assets. So first, let's discuss about bonds. Like, what is a bond? So we call like a security that promises a fixed amount of money at specific intervals. So, and this is the reason, because this a bond pays fixed amount. So the amount a bond is going to pay, that is fixed. So that's why sometimes we also refer to it as a fixed income security also. Okay. So in simple terms, we can consider bond to be a loan also. Like how? So let's suppose a institution or a corporation like Reliance Industries, it issues a bond. So what it says, like it issues a bond, like it issues a contract or a document which says like, yes, whoever holding this document, the Reliance Industries will pay this much amount at this time, at this time, at this time. It may be like, it may be paying on a single time, it may be paying on a regular intervals also. So and so in order to purchase that contract or that piece of paper, so you need to pay some money. So in that way, like you are loaning or lending that amount to Reliance Industries for that particular piece of paper or particular contract. So that's why it is a type of a loan. And in that way, Reliance Industries is in debt against you if you are purchasing that bond. Correct. So this is a simple.
Okay,
Yeah.
sir, okay, sorry. Can we ask questions again in between?
Yes, yes, yes. You can.
Okay, sir. Okay, so good evening, sir. I'm Lalit here.
Yeah.
My question is that, sir, that generally the bonds are issued either by the government or by the corporate,
Yes.
and like you said, okay, they have got a fixed rate, okay, of the return.
Yes.
But if you see, sir, the bond market like of the US, they are
Yes.
saying that the bond, okay, the kind of output which we are getting, it is on the higher side.
Hmm.
So my two questions are there. First, whether it is fixed, okay. Second, what is the risk associated with it, and how is it different from the fixed deposits in the bank, sir?
Yes. Like there are multiple types of bonds also. There may be like the returns on that may be linked to some other types of like other interest rates. Let's suppose like the key interest rate which we have, like in the case of US, that is the federal fund rate, or in the case of India we can consider the repo rate of like the RBI. So there are various types of bonds in the market. We are not going into that, like, because list is very long. But if you take a very simple bond, for example, if you take a government bond, like let's suppose very simple 10-year government bond, if you take that. So what in currently in India, a 10-year government bond, it pays like every 6 months it will pay a coupon payment which is fixed. Like it will have, like it will be already fixed at the time of issuance of the bond. And after, for every 6 months you will receive that coupon payment, and at the end of 10 years you will have a lump sum amount which you will receive when this bond expires. Correct. This is the simple, like the payment structure of a bond. And in the case of fixed deposit, like yes, that is also like a different type of financial asset. And in that case also, like your stream of payment is fixed. Like it is also a kind of, you are like giving that much money to a bank, and bank is in return, bank is like assuring you a fixed amount of like the interest payment on that investment. Yes. Is that answers your question or?
Okay. Yes, sir. Understood, sir.
Yeah,
Thank you.
sure. So so this is like a these are the basics of bonds. And in the lectures we also discuss like how a bond is priced. So it is like price of a bond is like inversely related to like what interest rate it is yielding. So if a bond is giving you high rate of interest, its price will be lower. and it's how much interest a bond will give you, like that depends on its risk of default. Like what is the risk of how much, what is the probability that this particular bond will default. So if there are higher chances, like if there are higher risk that a particular bond is going to default, if you are investing your money in that bond, then you will ask like, yes, I am taking this high amount of risk, then you should pay me more. You will ask for higher interest rate. So if risk of default is higher, then your interest payment is higher, and in that case, like the price of bond is lower. Correct. Now, what are the various features related to bonds? So like the at the basic level, there are 3 4 things which are associated with the particular type of bond. So first thing is face value or the par value, which is like what is the value it will give you when it matures. So for example, a 10-year government bond, it will comes with a face value of, let's suppose, 10,000 rupees. So after 10 years, if you are holding that bond, then government will give you 10,000 rupees. That is the meaning of face value or the par value. Second thing is coupons. Coupon means like the example which I gave you earlier. So in India, a 10-year government bond gives you every 6 months it gives you coupon payment. Coupon payment can be like a fixed amount. It can be in like the percentage of the face value, or it can be linked to some other financial market thing, like financial in other interest rates. Like it can be like it is defined, but when a bond is being issued, this coupon payment will be defined. There are there are zero coupon bonds also, which says like there will be no coupon payment. On the bond will pay the value at the time of maturity only, like when it matures. And third thing is maturity. So we are discussing like when this bond is going to mature, like how long this bond is like active. So for example, when we say like 10-year government bond, so maturity is 10 years. After 10 years, this bond will be repaid, and like that this bond will expire. After that, there is no value of this bond. And on the like who is issuing, that also matters a lot. So the one major player in this bond market is the governments. So government issues, like in order to raise money, so government issues bonds, and we call them government bonds. And another type of issuers are the corporates. So like the various large corporations, like for example, we took an example of Reliance Industries. So there are corporate bonds also, and also like how much interest they are paying, that determines their prices as usual. And who is issuing this bond, that matters for the evaluating the risk of default. And for example, as we discussed in the lectures also, like the government bonds are considered to be very less risky, like the risk of default on these bonds is very low. And in practice, like when we do our analysis, we take like 3 month treasury bills. So treasury bills say another term for the 3 month government bond only. So we take 3 month government treasury bills to be a risk free security. So whenever we are going to take like the risk free rate, then we will take like what this 3 month treasury bill is paying, we will take that rate to be a risk free rate. So that we take in practice we use that. Okay, any doubts if you have regarding bonds, any questions on that, we can have them. Okay, so next we discussed briefly about like the another type of financial asset. So that is stocks, or in general we call them shares also. So what are them? So it is a claim on a part of a firm, part of like assets of a firm. So for example, if you are purchasing shares of Reliance Industries, and if in the market, like there are, let's suppose there are 1 million, 1 million shares of Reliance Industries in the market, and you have purchased like 10 1000 1000 these 1000 of these shares, then you will be owner of like 1000 divided by 1 million times of the assets of this Reliance Industries. And you have that much claim, then you like the whatever profit Reliance Industries is making, you have claim on that also. Now, when a corporation makes profit, then it can either give it to the shareholders, and or it can use like this profit for the enhancing the business activities of its corporation. Correct. So when it like the some part of it, if it give to its shareholders, then we call them dividends also. So if you are holding some shares, then you may receive some periodic. So for example, if I am holding shares of LIC, so and LIC gives like every 3 months LIC gives some dividend. So it like every 3 months they are like the distributing some part of their profits to its shareholders. So we also call them these shares or stocks, we also call them equity, because who each share has a equal claim on the profits of that particular firm. That's why we call them equity, like equal right. Unlike the bonds, like these equities does not have any promised stream of payments, like you, and there is no maturity. So if you are holding a share, like there is no maturity. If you are holding, like you can hold it like for the infinite period of time until that particular firm is there in the market. And on like there is no, so we discussed about dividends, so there is no assurity that you will get any dividend if you are holding a share. Like it is completely on that particular firm of which you are holding the shares. So, and mainly these two types of financial instruments are used to raise money, which we also call financing also. So, for example, like, so why a particular firm issues a bond or issues shares in the market? So that they can get money from the public, like the other people in the market, and use that money in order to enhance their business activities. That is the main reason why company, like same for the government. So government raise money using the bonds and then distribute it among the public again for different activities. Another type of financial asset which we will be discussing later in the course are the derivatives. So a simple definition of derivative is like a investment whose value is determined by some other basic assets. So for example, a so examples of them are futures and options, and we will be having a like extensive discussion on these derivatives later in the course. So we will discuss them later. Okay, let's leave it there for now, as of now. So I wanted to touch these two topics because we will be going to touch on them again and again in our course. And other parts like which we mainly discussed was the global financial crisis. So that has been extensively discussed by the instructor in the lectures as well. So I have listed a key learnings which we had in the first week. Like we discussed the relation between the risk and return, and the famous ideas like high risk, high return holds. We discussed on that. We discussed the two types of risk, like idiosyncratic and the systematic. And like the first one is diversifiable, like like the we can exclude them if we build a portfolio like the intelligently, and other type we cannot diversify because we have to like we have to like we have to deal with it, we cannot leave it from our portfolio. Other and the basic principle of like the acting in the market is like you buy the underpriced asset and you sell the overpriced asset. That is the basic underlying agent, like the thing which you should follow when you are investing in the market. And for that you need to do your extensive research, like to find like whether this particular asset is overpriced or underpriced. That comes from the And we will be having discussion on this, like how you determine the value of a particular asset, that we will be discussing in this course. And from our discussion of the global financial crisis, like we found that the correlation between the correlation of default between any two assets is very important, and it should be considered in order to rate these complicated financial products. So this was the brief overview of first week, and later on, like in the coming weeks, we will be discussing
Uh, So may I ask a single question
yes,
before going ahead? So these two type of risks which have been explained, systematic risks and idiosyncratic risks.
yes,
So that has been understood clearly,
mm,
but both types of risk, they will impact the portfolio. For example, like COVID, okay, which came, so it was like a systematic risk
yes,
which we cannot avoid, and definitely it will have impact, and we cannot diversify.
yes,
Similarly, this idiosyncratic risk also, for example, I own like, some shares of a mobile company,
yes,
or for example, Mahindra and Mahindra.
mm,
And today news comes that Mahindra and Mahindra has launched an electric vehicle.
mm.
So definitely this will also have impact on the my portfolio.
Yes, it will have impact on your portfolio, but through diversifiable, what we mean, like we can exclude this risk from our portfolio. So if
Yes,
you,
sir. So the diversification part I have understood. For example, that idiosyncratic risk, they can be managed by diversification, by having my portfolio can be having like 20 fields. Okay, for example, in EV, in solar, somewhere. What I'm trying to say, that there was a statement during the lecture that this idiosyncratic risks which are there, they don't have impact on your portfolio. Is it true?
so when, so by portfolio, what we mean, like you want you want best portfolio for you, correct? And for that, what you do, like there are multiple, so let's suppose there are 100 firms in the market, and you want to build a portfolio from those 100 firms. Okay. So but when you identify a firm that has very high risk, so you will not have that, you will not have that firm in your portfolio. That's why, like, this will not impact your portfolio. That was the meaning of that statement, like when you are building your portfolio.
Okay, sir. Okay, sir. So there
Yeah.
is a why I asked you this question, because there is a question in the GA also,
Hmm.
that in that it has not been specified. First of all, that that person, does he own the Apple shares? Number one, because if he's having the Apple in his portfolio, then definitely launching of a new product by Apple will have an impact on his portfolio.
Hmm.
So now, if we correlate with the lecture, one thing is coming in the mind, that no, the Apple launching Apple will not have impact on the portfolio.
Yes.
But if I am having those shares of Apple in my portfolio, definitely it will have impact.
So the idea underlying this, like this portfolio creation, like you are creating your portfolio today, let's suppose, correct? Then we are discussing, like if you are trying to build your portfolio today, and today you find the information that Apple is launching, so then, like, you will not, like, if you build your portfolio, then this will not impact your portfolio which you are going to build. That is, and we will be having this portfolio theory discussion, like for 2 weeks, in like later, like I think week 7 or 8, we will be having this portfolio theory discussion. There will, there, like these things will be clearing out for you, like later in that. So how these portfolios are created,
Okay, sir.
correct?
Thank
Yeah.
So I just one question.
Yes.
So far, what we know, all the strategies and decision you are taking,
Hmm.
means it's taken with respect to the fundamental value
Hmm.
of a stock. Or
Correct.
now the question is, how to calculate this fundamental value in a simpler way, and so that I can able to know which way I should go.
Yes, like that is the major theme of this course, is like how you value a particular type of asset. So we will start from some basics, like we take very simple products. So very simple thing is, like if you know, like a particular asset or particular investment is going to give you some stream of payment, if you know that, then first we will value these type of assets. Then what should be the value of this asset today? Okay, that we will be doing first. Then we will keep on adding like various complications, like various uncertainties, various parts, like try to make them more realistic, and then we will do this valuation exercise again and again. That is the major theme of this course, like how we do this valuation. Correct?
Okay.
Yeah.
And it seems means sounding very interesting.
Hmm.
And I just want to know in upfront uh, how much practical it will be. Means the way, the technique, the method I learn from this course, I will directly apply on a practical thing. And how much confident I am कि my calculation, it's the calculation which is going to be hit.
So,
Because I am not guessing anything, I believe. I am calculating the fundamental value of that company or
so,
that stock.
so for like in like you cannot like get the exact fundamental value, because exact fundamental value is like there are many actors in the financial market and everybody is doing his or her own calculations. Correct? So
Mhm.
we are, I am not giving you like sure shot that yes you will be like doing the exact or exactly right in your calculations, but if throughout this course like you will have a basic understanding like how this valuation is being done. And if you see some event happening, so for example currently the markets are going down, correct, so you will have a basic understanding like what would be the reason. If you do some research like on your own and do read the like the reports of these particular firm, like for example if the prices of, let's suppose Reliance Industries is going down, then you will be able to do your analysis on your own that yes what would be the underlying reason why this price is going down. But
Okay.
as we discussed in one of the slides we had, like we cannot accurately predict these bubbles or accurately predict the prices, because these are all like the, so one of the like I think this Yugen Pharma's quote which was listed in one like the quoted by the instructor also, like we cannot exactly predict a bubble before, like we do not know. There are a lot of things which are there. But yes, if you do this course, then you will have a basic understanding like why a particular firm is priced higher and why a particular firm is priced lower, what is the reason. And not even firm or like the different financial assets, like what, why a bond from the Indian government is priced lower than a bond from the US government. So that we learned from our first week discussion only, like because like the risk of like the default of US bond is lower, it's in comparison to risk of like the Indian government bond defaulting, because of like, and if you see the ratings of these two bonds, like the US bond is rated AAA, where Indian bond is, I think Indian government bond is rated, I think AAA rated, triple B rated, sorry. So if you see these dynamics like the which you see in the news also, then you will be able to like you will be have a better understanding of these dynamics.
Okay.
Okay.
Okay, sir. I have got another question that, like in the week one lecture, it has been extensively covered that one of the main reason behind the this housing crisis or the financial crisis of 2008
Hmm.
was this manipulation of the securities, how securities they were made and how they were hidden from the rating agencies,
Correct.
and by creating those tranches, how something which was not supposed to be even like a double B, they were made triple A's.
Yes.
So still these practices are continuing despite knowing that they can be manipulated.
Yes, these will be there, but like this, after that crisis, like it it has come to the, like, the regulators have taken like many measures for that, like they keeps on checking the books of financial, like they have taken many measures after that, like how to rate, and these rating agencies are also regulated after that. Earlier, like these were the ones. Now, like the various government bodies, they also regulate, they keep on observing like what is happening in the financial market and try to, like, the not go to up to that level, like the, so that the whole of the financial system crashes in that event. So this gives we are not saying like we can avoid such situation in the coming future, but yes, like we will have, if we have a better understanding, then yes, we are aware that yes, we are going into that direction, and we take corrective measures upfront. We do not go down the line so that everything crashes down.
Sir,
Okay, so the first week was like just my take on the first week thing is like it is just gives you a brief and like the overview of like why we should learn the, like the basics of finance in first place, so that like if when such crisis happens, we can take the corrective measures. If we have a better understanding, then we will be able to take better decisions in such situations. Okay. Yeah. Someone was asking something. Yeah.
yeah, no, sir. mhm. I just want to share one idea of me. It
Hmm.
may sound silly, and just to make this whole, because this term we all of us have this subject, corporate finance.
Hmm.
Um, just only getting some marks in the exam, it's not the only purpose that I believe.
Hmm.
To learn the subject in a more deeper way and make it more interesting, I have just one small pen. Can we, sir, take maybe select any one company,
Hmm.
and we will, as the week progress, we will try to find all the learning we will apply on that company to get insight about the various direction of that particular company, so that it makes more meaningful. I can able to know, okay, I am learning this subject, so I can able to get dig out all these things from it. We can, with the exercise we will do, you will just show us the guidance. These are the thing you need to look. This is the way that we learn, and we have to calculate. This is the deviation, where this is the means band that you cannot predict the exact one, but with this tolerance, this will be the value. We want to have a small research kind of thing. Take set one company, and whatever learning that we will have in this 12-week course, we will apply and see what happens. This is just beyond the exam and all these things.
Yes, like you can do that. Like, yes, it is highly appreciated if you do that. But I think in this course, like we will be touching upon different types of assets. So, for example, we will be touching on the bonds at the start, like how we value different types of bonds, and then we will later in the course we will be touch upon like derivatives, like the mainly the options, like options how we can, like the create strategies based on options, how we value, like the valuation of option is done. We will discuss on that. So in my opinion, like yes, it is a good idea. If you take a particular firm, then you should take like a bond of that firm, then the price movements. Yes, you can do that analysis, and we can have a discussion on that also, like yes, why this, like the why these dynamics are pl- playing in the market, and we can have a discussion on that. Yes.
Okay,
Yeah, that
okay,
is a very good suggestion. Yeah.
okay.
So like in the coming weeks, like we will be at the start, like we will be discussing like how we do valuation of different assets or different projects. So for that, like we will be learning like how to calculate the present value. So for example, if we have a asset which is assuring you a stream of payment in future, then on basis of those future payments, how what is the value of that asset should be today. So that is the basic idea behind the present value. So we will be learning that, and then we will be learning the various capital budgeting rules, like whether a particular project should or investment opportunity is should be taken or should not be taken. That is the, so there are various rules which we follow. So if we are going to earn some profit, then we should take. That is the basic rule. And if we are going to get like incurring loss, then we should not take that opportunity. Correct. So we will be learning like how we do this. Then we will be learning some basic pricing models, like the very famous one, the capital asset pricing model, factor models. That like just like don't go into the, no, I'm not going into the details today, but yes, later on, like I am giving you a brief overview like what we are going to learn later in this course. We will have a discussion on the portfolio theory, like how we build our portfolio, and derivatives market, like mainly the options. And we had a discussion on the financial crisis, and we will have another discussion like how this financial crisis takes place, how it is related, and like in the foreign exchange market, like how markets are interlinked, like the Indian market is linked to the foreign market, like what is the exchange rate, how it is measured, what role it plays, and how, when, like, so for example the crisis happened in USA, that impacted the Indian markets also. Why is that? Because markets are very highly interlinked, and that is because of this foreign exchange market. So these are the topics we will be touching throughout this course, and I hope this course will give you a good overview of the financial market, and you will have a better understanding after completion of this course. Okay. Any questions and suggestion if you have? So I liked your suggestion,
Uh,
like we do a company research, and if you have any other, we can have them. Yeah.
Sir, I have got only one request here, and I have been requesting this in earlier courses also.
Yes.
That maybe if we can have an interaction maybe once in a month with the professor, so that
Yeah.
would be very, very useful to all the students.
Sure. I will ask the professor also, like if if he is available on any of the day, like any of the live session time. I will ask him if he is available. Then yes, I will notify you upfront through our discussion group, and I will let you know. Okay.
Thank you.
Yeah. Sure.
And so all the communication in the G space.
Yes, in the G space we will have. Also, I think there is a discourse forum also there for this course. I think I'm not sure whether that has been activated, but yes, that would be there. So
So all my findings and question regarding this company research, I will put it in the G space.
yes, you can, or otherwise, like on the discourse forum, you can create one like the discussion thing, like we can have that, so that would be better. So in this space, like the newer messages comes, then it keeps like the things gets older, so it is difficult to keep a track. But I think in the discourse forum, it is better to have these types of extensive discussions there. I think.
Okay.
Yeah. Any other questions? If you have, we can have them.
And sir, you will upload the recording sessions recording in the calendar itself, right?
Not in the calendar. So these like these meetings will be like the live streamed on the YouTube. So I have shared today's like the YouTube link
Oh, in the
in,
G space.
yeah, in the G space. So if you want to revisit them, you can go to the like that
Okay.
YouTube link, and you will have them there.
Okay. Okay.
Okay.
Hmm.
Any other questions regarding the course or any other thing? So if we don't have any questions, so we can close our meeting today, and we can, I like, we will meet next week again. Okay.
Yeah.
And
Thank you. Thank you so much. Have a nice day.
yeah, sure. Thank you. Thank you so much.